Hi, Catalina here. Today we're going to talk about, for parents, also people who may have already bought a home, or parents who have a home already who are thinking about how to fund their child's education, or if you have a home and you're thinking about going back to grad school in your 30s after you may have bought a home, in your 20s after getting that kick-ass undergrad job. I wanted to address the topic of how do you think about taking out a home equity line of credit versus taking out a student loan for either your education for grad school or a parent, in the case of a parent who's assisting their child go back to school, for example, right? Of course, it's ideal to say you should just save ahead of time, but that's not always possible, right? Recognizing the cost of living rises and the fact that you just don't have tens of thousands of dollars for every semester your child or you need to go back to grad school. So I wanted to share a really great USA News article on this topic, but of course I want to add my opinion as a student loan expert in the space as well, what can be considered outside of what this article covers, right? But I think it's a really, really great article, so I'm going to go over it here. So do not judge the number of tabs I have open, but essentially, how do you think about a parent plus loan or a grad plus loan versus a home equity line of credit, right? There's advantages and disadvantages to both. And first and foremost, like you could just look at straight up cost to borrow, right? That's the first part of the article. We look up the straight up cost to borrow. If you get a home equity line of credit, there's no origination fees most likely, and you're going to get an interest rate at this point in the market probably closer to 6% or so. But if you include the interest rate of a parent plus or grad plus loan, it comes to about 6.5%. So if you do a straight up like compound interest calculator, and then you include the origination fees they talk about here, and you compare it to what you can get with the home equity line of credit, you can make straight up make a financial argument, right? In many instances, the home equity line of credit wins because you have an asset backing up that loan, plus there's fewer origination fees, right? So it ends up, in the instance in this example they use here, it ends up winning by, right here, by about $3,000. So if you want to get into the nuances, you can look at the average plus loan. Let's say you're borrowing $29,000. There's an origination fee plus interest. By the time you repay it, you're paying about $10,000 of interest. So a $29,000 loan would come to about $40,000 by the time you pay it back if you do it over the 10-year repayment period. Took out a home equity line of credit, it's 5%. So you end up paying about $37,000, so it's $3,000 cheaper in this example. Obviously, the rates may be different for a loan you're considering, and your home equity line of credit interest rates may also be different. But the point is you can do that analysis and make it a straight up financial decision, right? They also want to talk about this article that I think is really, really helpful and important to consider, is that home equity loans are more tax efficient because you can write off more of your interest payments off your taxes as compared to the amount of student loan interest you can write off on your taxes. It's capped at $2,500, so if you're paying back more interest than that, your home equity line of credit doesn't cap it to $2,500 like the student loan program does. So if you write that off your taxes, that is a more tax efficient option, right? So that is like the value of having home equity and being able to borrow against it. However, there's an aspect that the article addressed that I want to get into a little more detail about as well. Is saving $3,000, like you have to calculate, like this is how you make the analysis. Is a $3,000 savings better, right? Better, is it better? Is it not just better, but is the risk you're taking, because it is your home, so if you don't pay it back, you can get evicted, you can get, not just evicted, I'm sorry, you can go into foreclosure, there's risk, and it's a physical place you live in. Is the risk high or low, right, relative to the benefit. So is $3,000 savings, obviously if you take out much more loans than that, it might add up to $10,000, $20,000 of savings. How do you consider that savings amount against the risk of putting your home on the line? And how you can think about that risk is, future unemployment. If you were to be unemployed, could you rent out a part of your house to help make the payment? Like, what are the true risks of borrowing against your home, right? And is the amount of savings worth the risk? That's the first part I like to think about. The second part I want people to think about is the opportunity to borrow, like if you do it fully amortized over 10 years and that's the only analysis you're doing, is that appropriate for the circumstance? For example, if you're a parent working in a hospital system, you're a public servant, you could get those loans forgiven over a period of 120 payments, which is 10 years. Also, if you experience unemployment, the federal student loan program allows you to get in a plan based on your income all the way down to $0. So is the savings on a home equity line of credit worth it relative to the risk you're taking, in addition relative to the benefits you could get from the student loan program, which is that if you do in fact lose your job, you can get a $0 payment for the year. If you work for an employer that you can accelerate and get loan forgiveness, then that's a benefit. Like, it may not be as easy as a dollar-to-dollar comparison, but also what are the possible benefits post graduation? Like if you're a grad plus loan and you know you're going to go work for the public sector, there's various other, if you know you're going to go work for an employer who may help you pay the loans, there's many factors to consider with what's going to happen post graduation, either for you as a grad student or for your children as well, as for you as well, because if there's opportunities to enroll in loan forgiveness programs, if there's opportunity to mitigate the risk by enrolling into a federal program that allows you to reduce the payment, potentially get loan forgiveness, then it's not as easy as a dollar for dollar comparison, and the risk of taking the home equity line of credit may not be worth it in light of the fact that you are putting up the house for collateral, right? So what I would say to parents or to you or to an individual considering going back to get grad plus loans or parent plus loans is to really understand what this degree will be able to help you or your child achieve, what type of career they want to go into, if they can get any specific benefits from the student loan program or from employer-based programs post-graduation, and if there are benefits, like let's say they go work for a consulting company that helps them with loan payoff, who knows, there's all kinds of various programs, then by taking a home equity line of credit, on you as a parent, are you essentially taking on that risk when your child or you yourself could have gotten some form of assistance with your loans or some form of forgiveness in which taking that risk just doesn't make sense, right? So those are a few things I do want to bring up. In addition, like, keep in mind, like the CARES Act, we went through 30 months of $0 interest, right? Which for somebody who's a public servant, that's 30 months of basically of their loans being forgiven, right? By the way, do not forget to file by the end of October to be considered for the limited PSLF waiver program. But the point is, it's not as straightforward as calculate the savings. It's what are the savings against what are the risks against what can the potential in the future be, and you have to consider all those things together. And also, like, what is the risk of not knowing what the future holds, right? Unemployment, economic recession, and what can that do if you now are stuck with, rolling in your student loans payment into your mortgage, right? So there's also inherent risk in doing that, and to just consider all the possibilities. If you're an individual that happens to have some family safety nets, like having either family that could step up or whatnot, and that's not as big of a risk, that's great, but I know the average person does not have all those security and safety nets. So it's just understanding the full picture. It's not as straightforward as just the monthly savings. So I hope this article helps. I'll link this article below. And I think it does a really good job of helping you think through the key factors. And I hope this video helped you in addition to think through, like, how do you think about the savings versus the risk versus the future potential of potential loan forgiveness, or what your full options are. And you weigh that all together. It's not just a single piece of information, because oftentimes in the financial world, we think decisions are all about financialization, like numbers. But it's also, at the end of the day, about what we as humans are comfortable doing and what we as humans are comfortable taking on, right? So understanding all those risks and those benefits is really vital. Please let us know if you have questions, comments. We can't wait to answer them. If you know of somebody for whom this content would be helpful, please make sure to share it. If you're a loan officer that wants to present the possibility of a home equity line of credit and want to present that savings to your customers, please do so. I mean, it could be a huge benefit to those who have the safety net and just want to save month over month, right? And the home equity line of credit may make the most sense for those borrowers. So please do not hesitate to share, like and subscribe to our channel, and we wish you a great rest of the week.